How's it going? I'm Andrew with Investors Hub, and we're talking about meme stocks, and we're talking about short squeezes today. Talking BlackBerry and AMC, CLOV, GME, all those companies that people are piling into. And I wanted to frame this talk, which we're having with Paul Schatz from Heritage Capital, by the way. And I wanted to frame this talk in an evergreen sort of way, right? I wanted to talk about meme stocks and short squeezes in such a way that when the next one emerges, this video will still be relevant and still be important. So we're talking in generalities, right? What are the financial mechanisms in place that make these short squeezes happen? How do they work? What is short selling? And what are margin calls, and what's short interest, and all these things that you're going to be seeing on forums and in the news. And hopefully we can clarify some of those things and break you into the next tier of investing. And if you're already in that tier of investing, we also he shares sort of his perspective on what's going on with meme stocks. And it might be worth it just checking it out for review. So yeah, if you like the video, be sure to like, comment, and subscribe. You can also follow us on Twitter, ihub_vision. Share us with somebody who is thinking about getting into meme stocks. And after a quick disclaimer, we'll hear from Paul. Please note that our videos are not designed to be direct investing advice. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. So with meme stocks like AMC and BlackBerry and CLOV and now Wish too, all popping off, I figured that we could have a talk that was more centered around some of the financial mechanisms that are in place in order to make these meme stocks and these short squeezes happen. So talk to us a little bit about what a short squeeze is.
So a short squeeze is when price of let's just call it stocks, price of the stock rises sharply and unexpectedly. That in itself is not a short squeeze. That's how they begin. And before that happens, a stock has to be, I'll say, heavily shorted. That means a lot of people have to be playing for the stock to go lower than higher. Because when somebody is playing for the stock to go lower, they borrow shares from people who own the stock to effectively sell that stock into the market and replace it at a later date in their hopes at a lower price. The short squeeze happens when a lot of people are short a stock and something happens and that stock jumps. If you're short the stock, hypothetically, you have unlimited upside risk. In your case, that's really your downside, because the stock can go up, 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 up. On the downside, you can only lose 100% if you own the stock. So that short squeeze, the minute that ignition gets lit and the stock begins to go, people who are short the stock begin to cover, meaning they have to buy stock back. And that begins to feed on itself. And your stock goes right up the side of the page. That's how the whole function of it works. It can happen for a variety of reasons, and it usually does.
So there's been a variety of different short interests that have been seen in the meme stocks, right? So at the height of GME, it was like 120% short interest. But right now, AMC, the last time I checked, was only about 30%. So what is a high short interest percentage? And do you absolutely have to have a high short interest percentage for there to be a squeeze?
You never need high short interest, because as it's happening, you don't know while you're watching the stock whether that is somebody covering their short or just organic or normal buying. So you mentioned GME was 100%. I think you said it was 120%, and AMC, the last numbers were in the 30s. Sure, each market environment, you'll see different levels matter. In some environments, it will take 50, 60, 80%. Sometimes you just mentioned GME, the short interest was over 100%. And now you get AMC, the short interest is in the 30s. There is no hard and fast threshold that can trigger something to happen. And the numbers that we get are not in real time. So there's always a lead lag effect too. I would just say this: take all the data that you're seeing with a grain of salt, because rarely will you get data in real time. You can watch price action and know something's not right. This security is no longer behaving like it has previously. When that begins to happen, the last thing the individual investor should do is sit back and say, okay, I'll just wait. If something's not acting like you believe, if you have doubt, I love the expression, 32 years doing this, when in doubt, get out. Always protect your capital, protect your principal first and foremost. There'll always be other opportunities later on.
So why do short sellers get put in this position where they are forced to buy back into the stock? And why can't they just ask for more time?
There's a number of reasons. So let's think about it. If I've got, let's call me, hedge fund Q. I've got money at Goldman Sachs. So I want to go short AMC. I call Goldman Sachs up and I say, hey, I want to short 1 million shares of AMC. Goldman now has to locate those shares to lend to me. So they look in their margin accounts and say, okay, boy, there's not a lot of AMC in margin accounts. So therefore, that would be called hard to borrow. I can't borrow it so easily. Goldman, I'm going to borrow the stock to short. Goldman is now going to charge me an interest rate. And the person who owns AMC in their margin account, they're going to get some of that interest that Goldman charges me. Goldman and the person who owns the stock share in the interest. Now, the harder a stock is to borrow, the higher the interest rate. When things go really crazy, you could hypothetically, actually in real time too, you could see interest rates go to 30, 50, even 100% for really hard to borrow stocks. So first, Goldman Sachs could say to me after I short the stock, hey, we no longer have it in margin accounts. We're buying it back in. We're forcing you to buy that stock back in. So any of the brokerage firms could do this. That is when you sign a margin agreement and you sign the agreement to borrow stock, you're giving the broker the opportunity to set the rules and they can buy back the stock at any time. Two, they could raise the interest rate. So if I'm short AMC, but I'm paying now, I was paying 5%, now I'm paying 55%. That's an awful lot of money to spend to be short the stock. That could also force people to buy back their stock. Three, you can get a margin call. If you short the stock at 10, the stock is now 20. You've now lost clearly 100% of your money on a notional basis. Goldman or anybody else, TD Ameritrade, Schwab, Fidelity can now say to you, hey, Mr. Hedge Fund, we want more money up front. You're going to have to put more money on deposit with us. There are many ways that the brokerage firms could force this short squeeze. Additionally, a heavily shorted stock could get a piece of good news. Some cancer drug could have great clinical trials and that will send the stock up. AMC could have gotten funding and stave off bankruptcy. That could send the stock up. The stock could be in play. Someone could be looking to buy the company out. That could send the stock up. So there's all kinds of factors where the stock would go up and the broker would say, hey, we want to take your stock back or force you to put up more money.
So earlier you mentioned like misinformation or sort of misrepresentation of what's going on. So talk to us a little bit about the difference between short interest and short volume ratio and days to cover.
Now it's going to get a little wonky for the average investor. So I think you mentioned short interest first. The NYSE keeps track, and NASDAQ does too, of how much stock is, I like to look at it on a percentage basis. So let's just for argument's sake say there's 100 shares of company ABC in the hands of individuals. And millions of people own these 100 shares through fractional shares, we'll say. Now the short sellers get hold of 50 shares, 50. So now 50% of the shares out there are now held on the short side. So your short interest is 50%. Short volume is the amount of short shares, easy for me to say, short shares traded on a daily basis in share amounts. They're very different. The days to cover is a totally separate conversation. So let's say, again, our hypothetical example of company ABC, 100 shares are out there in public, or in everybody's hands, public hands, we'll call it. 50 shares are shorted. And what they look at is, what's the average volume of my ABC company that has 100 shares out there? So let's say my average volume is 10 shares a day, and there are 50 shares outstanding. That will take 5 days of average volume to cover that. The longer, the higher number of days it takes to cover, once that short squeeze gets going, the more the people who own the stock are going to likely benefit, because frankly, once you're getting that genie's out of the bottle, that the horse leaves the barn and momentum begins, like we saw with GME, like we're seeing with AMC, once the shares get going and there's high short interest like GameStop, the shorts are in trouble and they get it from all sides. So a lot of those shorts begin to cover a little bit at a time to make sure that their risk is no longer, boundless on whatever money they invested in the short side. It's a much tougher game today than it's ever been to be on the short side.
So whenever a share price starts exploding and the company in question is usually not doing super well. In the case of a short squeeze, that's why they're being shorted. So they're going to be extremely tempted to issue new shares in order to get more capital, right? Because all of a sudden their company is worth 3, 4, 5, 10 times, 100 times what it was worth before. And so now they really want to cash in on that. So who controls the ability to issue new shares?
A lot to unpack there. So let's start. So companies with high short interest usually have some, I don't want to say questionable financials, because a lot of the stocks that have high short interest are just those hyper growth stocks that went straight up. Doesn't mean that there's anything wrong or nefarious. I mean, look at Tesla. Tesla went literally straight up, and people kept shorting it and shorting it because it became a relatively expensive stock. If you want to look at PE ratios or book value, but it really went straight up, and the short sellers believe that that price will revert back to the mean, as quick as it goes up, it's going to come down at least half of what it gained. But your question regarding company issuing shares, yeah, if I were AMC or GameStop or any of these companies that saw sudden blast offs in my shares and I needed capital, that's the key. We don't just want to issue shares and dilute everyone's ownership right now. You only want to issue more shares if you can't take advantage of the debt market to borrow at low rates, and you need the money. Not every company needs the money. Some companies still have a war chest of cash, but their stock is still shorted. So let's say your company does need money, like AMC perhaps did or does. So first, only the shareholders can authorize the share count to increase from what is available in the company's treasury and in the public's hands. It's the board of directors that decide when to sell those shares public. So let's say in my hypothetical example, company ABC has 100 shares in public hands. In the company treasury, they have another 100 shares that is sitting in the vault. We'll call it the vault, if you will, the virtual vault. Shareholders already voted to allow that extra 100 shares to sit in the corporate vault. The board of directors decides, let's go do a secondary offering. Let's get those shares out of the corporate vault and let's put them into the public's hands through a secondary offering that JP Morgan and Charles Schwab are going to do. So now, instead of 100 shares out there in the public domain, there are now 200 shares in the public domain. More shares out there, which dilutes your ownership. So companies during crisis times like the fall of 2008, banks were issuing shares at the worst possible time when their share prices had collapsed because they were out of money. They couldn't go to the bond market, and they had to sell at absurdly low prices. Today, with GameStop and AMC, they're issuing shares at absurdly high prices, and they know it. Everyone knows it. So if you're a shareholder, you don't want them to do that. You'd rather keep the shares in the corporate vault and let the share price go. You're a company, you say, geez, my stock was $9 and now it's $29. Let's go sell some shares to the public. We'll get some more shares out there. The price usually on the announcement of the secondary offering, the price usually will come down by some percentage to account for the dilution in ownership.
So let's say that I want to roll the bones on a meme stock, right? I want to hop into the hype and I want to play the game. So what kinds of press releases or government documents or news releases should I be sort of keeping my eyes out for to see if the ship is sinking or has sailed and I'm about to be left in the water?
You can look all you want. You can scour the internet for information. You can do whatever you want. My view is the fact of the matter, you're not going to know. You can read the message boards. You're going to see all the conspiracy theories. You're going to see all these rumors going around. But the bottom line is, no matter what diligence you do, you're frankly just not going to know. When something goes wrong, you'll see it in the share price first. And as maybe as simplistic as this sounds, and some will say a bit ridiculous, the shares reflect of what's going on today. When a company is about to fall on more difficult or more challenging times, you'll see the share price inexplicably start to roll over slightly. You'll see some odd behavior. Perhaps you'll see some big blocks of stock being traded in the last hour of the day. So that's always a bit of a head scratcher. The institutions are much, much better at hiding their movements in 2021 than they were when I came in the business in 1988. But sometimes, elephants leave footprints. I will say this, keeping on my elephant analogy, when a stock goes vertical, something goes wrong, and it becomes public information. Think about the door jam at your house and a bunch of elephants all trying to squeeze out of that door jam at the same time. What happens? The door jam explodes pretty quickly. So the first leg down, you're not going to know, frankly. It's going to look like any other pullback in your bull market in the stock. Look for some unusual volume signs. In the options market, look for some unusual put volume, people looking for lower prices. But again, I don't think you can scour the internet enough. Company's not going to issue a press release until long after the share price has fallen. You won't see any of their quarterly filings until long after something's gone wrong. You're going to have other means and metrics, whether you want to use a stop loss order on your brokerage account, whether you want to mentally watch the price and say, okay, I've had enough. That's a little more difficult because it's so subjective. But really, once something melts up, you better protect some. Depending on how much melt up, I love to peel back little bits and pieces along the way on the way up until I have half of the position I had when I first bought the stock. So if my position was 10% of my portfolio and the stock's melted up, I may be back to the stock may have gone from 10% in my portfolio to 20%. I'll sell half, so I'm back to my original 10%. Bottom line is, the average investor, don't sit idly by and watch your stock be like a .com, go straight up and then straight down. What's going on with the meme stocks today? Now the .com, they may have had zero revenues and zero earnings and revalued eyeballs, but today it's just .com part 2. Companies may have earnings and they have revenue, but the psychology around the meme stocks is eerily reminiscent of the .com era. And that's when people will say, okay, Boomer, what do you know?
So do you have any positions in the companies mentioned?
We do not own any GameStop, nor do we own any AMC. I know there's a bunch of new meme stocks that are out this week, and to the best of my knowledge right now, we own none in the portfolio. I would frankly trade, and I have traded some of the meme stocks. for me, they would not be core positions. I would sprinkle them on the outside of a portfolio, maybe own 1% to 2% of, let's say, AMC or GME or CLOV or anything else. And then again, I would trade it very aggressively. I wouldn't position for it for the long term.
Hey, thanks for watching, and be sure to like, comment, and subscribe if you liked the video and you haven't done it already. Follow us on Twitter, IHub_Vision, and I'll see you again soon.